Hello everyone, this is Matt Hogan, the CEO of Inside ETFs. I'm here at the Inside Smart Beta Conference talking about factor investing. Here to talk about that with me, Scott Williamson. Scott works on heads the pension group at iShares at Blackrock, and Raman Subramanian, who is the head of applied equity research at MSCI. So you guys are right in the heart of where institutional users are using these new factor strategies in their portfolio. Scott, let's start with you. Who is using it, how are they using it, and how has that evolved over the last few years?
So to take your last question first, usage is increasing notably, and I'm talking about the pension space, the public sector, the private sector. There's various ways they're using them, from a tactical version, from liquidity, from some alpha sourcing through those kind of expression of views in different areas. The factor area is very interesting because we're starting to see the difference between active and passive, and replacement in some cases of active managers. So a lot of different uses.
That's what I was going to ask. Are you seeing a lot of replacement of passive portfolios or a lot of replacement of active mandates within the pension
Fair question.
community?
We're seeing it really being funded from both sides, if you will. So you're seeing folks coming from the passive side where they're taking some of the passive money and they want to have achieve a risk premium off of the passive book. But we're also seeing a case where underperforming active managers are being replaced by some of these smart beta or factor approaches.
Right. Raman, I'll turn that to you. When you have that same question, do you see these, are you researching, developing these strategies as replacements for a passive core or for those active mandates?
I think from a pure benchmarking perspective, we are thinking more as a benchmark as a first use case. So if you have an active manager who is a value manager, and if you really want to see the performance of his outperformance, so you want to give him the appropriate benchmark. So the idea is to create a better value benchmark, and that get translated into an ETF. And
do you think that's going to expose a lot of active managers as not really providing the kind of true stock picking exposure they want?
I think that's the institutional use case. Even if you look at the pure beta benchmark, that was done to see whether the active managers are doing the job.
Right.
So we will see the same evolution happening in the smart beta space, where these factor indices are being used as appropriate benchmark to represent their investment process. So in essence, what's going to happen is that some of these active managers may not deliver alpha relative to that benchmark, then becomes a passive replacement strategy utilizing these smart beta indices.
Right. Now, do you see advisors using ETFs differently than institutions, the new factor ETFs? Do you see differentiation in the usage?
So I don't cover advisors,
right.
I cover the pension community, but what I can tell you working with iShares, in the advisor space, I could see more core usage of ETFs, whereas in the pension space, it is much more thought of as an exposure tool.
Right.
Meaning it's often a complement to a core exposure. Possibly it's there for liquidity purposes, possibly it's there for a tactical expression, possibly it's there just for rebalance terms. But usually it's used on the edges, on the margins, in some places core. The advisor, lots more core usage of ETF to actually build the entire portfolio.
Now, just for our viewers who don't know, when you say it's used for a liquidity purpose, what do you mean by that?
So what I mean by that is that the ETFs that are trading on exchange, in many cases, are trading in significant volumes above even the, for example, cash bonds in the fixed income market. And therefore, clients are able to get on size and with speed and low transaction costs because of the high volumes in these ETFs. And therefore, they can build liquidity solutions using ETFs to complement their underlying bond or equity portfolios.
All right, last question to you, Raman. Let's look forward. We've seen a lot of development of single factors, 5 or 6 of them. We've seen some multi-factor work. What is next? What's on the cutting edge of factor research right now?
I think one development will happen beyond equity as an asset class. So we'll see more multi-factor or even single factor products coming out in the fixed income space and in a commodity space, and currency is already happening. But more importantly, within the equity space, we think that there has been talk about more of this ESG, so environmental, social, and governance. So question becomes, can I integrate ESG along with the traditional factors? So if I have a min-vol portfolio, and if I'm also trying to have a enhanced ESG score for that min-vol portfolio, can I do it? And our research shows that you can do it without losing the efficacy of a min-vol in terms of reducing the volatility. Yeah. So I think the next 3 to 5 years, if I say, you will see more and more work coming around, either integrating ESG within the equity space or multi-factor in other asset classes.
All right, ESG, liquidity sleeves, we'll be watching. Thanks very much, guys.
Thank you very much.